Hey everyone, welcome back to Corporate Decoder. Today ACP just filed its semi-annual report, and I am seeing a mix of steady income and some new financial plays. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a peek into how the fund is performing and some big changes that have happened recently. This is a report for the abrdn Income Credit Strategies Fund, also known as ACP. It is basically a financial company that invests in bonds and other kinds of loans to try and make money for its investors. The goal is to get a good amount of income and also hopefully see the value of investments grow over time. This report covers the period up to the 30th of April, 2026. Looking at the performance numbers up to the 30th of April, 2026, the fund's value based on its net assets, that is called NAV, went up by 4.41%, the price that people were actually buying and selling it on the stock market, that went up even more by 6.50%. Now, to see how good that is, they compared it to an index. Kind of like a benchmark for similar investments called the BofAML Global High Yield Constrained Index. That index only went up 2.38%. So the fund actually did better than that benchmark. Scroll closing brewer market brewery price scroll premium pluses brew discount. Scroll now, let's talk about how the fund's price on the stock market compares to its actual value called NAV. On the 30th of April 2026, the NAV was $5.65 per share, but the market price was $5.45. This means it was trading at a discount of about 3.54%. A little earlier, in October 2025, the NAV was $5.89 and the market price was $5.57, meaning it was trading at a bigger discount of 5.43%. It is common for these kinds of funds to trade at a discount, meaning you can sometimes buy them for less than what their underlying investments are really worth. Here is something interesting. Around November 2025, they changed how they invest. Before, they wouldn't invest in risky debt that was already in default. Now, they're allowing themselves to invest up to 5% of their money in these defaulted debts, while still being able to invest in ones that are likely to default. This could mean they're taking on more risk to try and get higher returns. Big news here: in December, they sold new shares called Series of Mandatory Redeemable Preferred Shares. They raised $100 million from this. Part of that money was used to pay off their existing loans, and the rest was used to make new investments. These shares are rated A by Moody's, which is a good rating, but they are still a form of borrowing for the fund. They also have these series of perpetual preferred shares. As of April, there were about $60 million worth of these shares. They also have an AU rating from Moody's and are traded on the New York Stock Exchange under the symbol ACP-PA. These are a bit different from the mandatory redeemable ones because they don't have a fixed date to be paid back. The fund tries to give shareholders a steady monthly payment. For the first half of 2026, they paid out about 46.5 cents per share. This works out to a pretty high distribution rate, especially when you look at the market price. Based on the market price of $5.45 in April 2026, the annualized distribution rate was over 17%. That is a very high payout. The fund uses something called a revolving credit facility, which is basically a line of credit. It was set up with a big bank and had a limit of $400 million. But after they got that money from selling the new preferred shares, they lowered the credit limit to $300 million. On the 30th of April 2026, they owed $180 million on this credit line. This means they're using borrowed money to make more investments, which can amplify gains but also losses. Looking at how they invest their money as of April 2026, most of their investments are in corporate bonds, making up over 137% of their net assets. This shows they are using leverage, borrowing money, and investing it. Their investments are spread across many countries, with the United States being the largest at 31.4%. Followed by Europe at 30.4% and the United Kingdom at 28.3%. When we look at the quality of the bonds they own as of the 30th of April 2026, none of their investments were rated AAA or AAA. Most of their investments are B or BB rated, which are considered lower quality, meaning they're riskier. About 59.6% are rated B and 22.4% are rated BB. This indicates a focus on higher risk, potentially higher reward investments. Most of their investments have maturities of 0 to 5 years, making up 73.1%. About 24.3% are in the 5 to 10 year range, and just 2.6% are longer than 10 years. This suggests a mix of shorter and medium term investments, with a slight tilt towards shorter durations. Now, let's dive into some of the actual companies and bonds they own. This is a really long list as of the 30th of April 2026. they have a big chunk in corporate bonds. For example, under France, they own bonds from Société Générale SAR. It is a variable rate bond that pays 9.38% and matures in late 2027. They also have a large holding, over $15 million, in a German company called Cheplapharm Arzneimittel GmbH. In the United Kingdom, they have a sizable investment in Wagabond Co. Limited, with a coupon of 8.50% and a maturity in 2030. The biggest concentration of their investments is in the United States, making up 43.4% of the portfolio. Within the US holdings, they're invested in some familiar names like cable companies and energy companies. They have quite a few bonds from United States issuers. In fact, over $307 million in corporate bonds. This includes significant investments in companies like Venturi Global LNG, inked with bonds due to mature in 2032 and 2033. They also hold about $26.5 million in a money market fund, which is usually a very safe place to park cash. It is earning a decent rate of 3.60% as of April 2026. Overall, their total investments are valued at over $1 billion, but the cost to acquire them was a bit less, around $1.05 billion. This difference tells us that some of their investments have gone up in value since they bought them. Let's look at the fund's financial health. As of the 30th of April 2026, total assets were over $1 billion. On the liability side, they owe a significant amount. They have $180 million on their revolving credit facility, which is that line of credit. And $100 million for those series are mandatory redeemable preferred shares they just issued. Plus, they have other debts and expenses. After accounting for all the debts and preferred shares, the net assets for the common shareholders come out to about $708 million. This means for every dollar of preferred shares and debt, there are about $2.3 in net assets for common shareholders. Scroll net asset value. Per S-share based on 125470678 common shares issued and outstanding scroll. And for each common shareholder, the net asset value per S-share is $5.65. Looking at how the fund made and spent money for the first 6 months of 2026, they earned over $44 million in investment income, mostly from interest on the bonds and loans they hold. Their expenses, however, were about $15 million. This includes investment advisory fees, interest on their borrowed money, and payments related to those preferred shares. After all expenses, they had a net investment income of almost $29.3 million. That is a pretty good chunk of money. They also had some gains from selling investments and from the changes in the value of their currency contracts. Overall, the total change in the fund's net assets from its operations during this period was over $29 million. That is a positive increase, meaning the fund grew in value. This table shows the changes in the fund's net assets over time. For the 6 months ending April 2026, the net assets increased by about $28 million after all operations and distributions. However, when we look at distributions paid to common shareholders, they paid out nearly $59 million. This means that despite the fund's operations making money, the money paid out to shareholders was more than what was earned from operations, leading to a decrease in total net assets for the period. The statement of cash flows tells us where the actual cash came from and went to. They generated about $39.6 million in cash from their operating activities, mainly from buying and selling investments, but they also paid off $80 million from their credit line and distributed nearly $60 million to shareholders. This outflow of cash for financing activities was larger than the cash generated from operations, resulting in a net decrease in cash for the period. Now let's look at the financial highlights per S-share. The net asset value per S-share at the end of the period was $5.65, down from $5.89 at the beginning of the 6-month period. This decrease in NAV period, despite positive net investment income, is mainly due to the large distributions paid out to shareholders. The total investment return based on market price was actually quite strong at 6.50% for the 6 months, showing that even with NAV going down a bit, investors were seeing gains on their market price investments, likely driven by those high distributions. Looking at the leverage, the asset coverage for their credit facility was about $5,714 for every $1,000 borrowed as of April 2026. This means they had over 5 times the assets needed to cover that specific debt. For the series of perpetual preferred shares, the asset coverage per S-share was pretty high at $642.87. This indicates a strong cushion of assets backing those shares. Moving into the notes which explain the details behind the numbers, they define how they value their investments using a 3-level system based on how easy it is to get a price for them. Level 1 is for prices easily found in active markets. Level 2 for prices based on observable data, and Level 3 for prices based on less observable data and more assumptions. This table shows how the value of investments that are harder to price, those in Level 3, have changed. It indicates that while the overall value of these Level 3 investments is not huge, there have been some fluctuations and changes in their valuation over the period. The fund also invests in restricted securities, which are investments that can't be easily sold because they aren't registered with the public. This means they might be harder to get rid of quickly if needed. They use forward foreign currency contracts to manage risk when they invest in other countries. For the 6 months ending April 2026, the fund had unrealized appreciation of about $63,000 on these contracts, but also a substantial unrealized appreciation of over $8.2 million on others. This shows there were mixed results from their currency hedging strategies. The investment advisor fees are set at 1.25% of the fund's managed assets. However, for the period covered by this report, the advisor agreed to limit some of the fund's overall expenses. This means the advisor is effectively waiving some of their fees or covering some expenses to keep the fund's costs down for investors. For the 6-month period, they waived over $260,000. The notes also detailed the series of mandatory redeemable preferred shares. They were issued in December 2025 at a liquidation value of $25 per S-share, and they pay a fixed dividend rate of 5.525%. These shares are mandatory redeemable in December 2030. The estimated fair value of these shares as of April 2026 was over $100 million, very close to their liquidation preference, suggesting they are valued close to their face value. The revolving credit facility, that line of credit, has various conditions the fund must meet, like maintaining certain asset coverage ratios. If they don't meet these, it could lead to serious problems. They also need to maintain net assets of at least $100 million. Under the investment risks, they specifically mention the Russia-Ukraine conflict as a major risk. They point out that the ongoing hostilities can severely affect regional and global economies, impacting markets and potentially causing wide swings in the price and liquidity of certain investments. Finally, looking at the tax information, the fund's cost for its investments was over $1 billion. However, the current market value shows an unrealized depreciation of almost $40 million. This means that on paper, the fund's investments are worth less than what they paid for them. Overall, the ABN Income Credit Strategies Fund is playing in a higher risk investment space, focusing on lower rated bonds and using leverage through a credit facility and preferred shares. They are generating a lot of income, evidenced by the high distribution rate, but this comes with increased risk, especially with the recent policy change allowing investment in defaulted debt. The fund's net assets have decreased due to significant distributions, even though the investment operations were positive. The key takeaway is that it is a fund leveraging up and focusing on higher yield, higher risk assets to generate income for investors, with ongoing currency and geopolitical risks to watch. The concern I always have with funds like this is the magnification of losses when markets turn south, and the impact of those high distributions on the fund's long-term capital base. What I am actually looking for is how they navigate through potential market downturns with their current leverage and asset allocation. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this was valuable, hit like and subscribe, and check out our Discord in the description.